Now, when you look at swing points as a with a technical perspective, it's actually important to focus on the close of candles or close of time frames, which actually means, should you want, you don't need to necessarily look at the candle chart. You could look at a chart like this, a mountain chart or area chart, depending on what your broker calls it. And actually, you can get a really good view of swing points with this type of chart. Now, like I've said with many things when it comes to the technical aspects of trading, there is no one trading system that is going to be 100% most accurate on every stock out there. There is going to be a trading system that is correct more times than others. Sadly, haven't really found a way at this point in time to see some fail-safe program that makes sure and guarantees you never lose on a trade. One thing I have found, though, with trading in general is that if you're trading, which is much different than investing, it is something that's based on repetition and reoccurring scenarios and conditions and specific rule sets and disciplines. That being said, to have a success at it, you have to make sure that you're able to follow those disciplines over and over and over again, so that based on your study before ever even trading something and the times you've seen inaccuracy in a technical system can also be portrayed in your results of trading it. There's a lot of times, just to make an example, I don't know if Johns is in here right now, but there was an instance yesterday, okay? Yesterday, we've got a little trade that we do almost every week on Baidu. It's a little strangle trade, and yesterday was a little bit difficult to get into that trade on the call side. The spreads were wicked, so I was kind of waiting, and then we had to take a completely different strike. And there were some people that ended up not getting the calls, and Johns had mentioned in chat today that he decided he didn't want to chase, so he was waiting for him. And we actually talked about, even though the situation didn't work out well for him, he was still able to see the consistency in that trade that we did, because that trade that we did, whether he individually got it or not, he saw it work out yet again. So, that's a situation where it can suck at times, especially, I was sitting there watching it, trying to nitpick it a little bit, and sure enough, ended up having to chase a little bit myself. But a lot of times people get discouraged with trading systems because I hate to say it this way, it's almost inevitable. You can spend days, weeks, months studying a chart, narrowing it down to something you find to be most effective. And what almost always happens on the very first trade you enter using that system, that, man, you finally got the confidence to trade it. You finally got to that point where it's like, you know what? I'm seeing consistency. I want to trade this. And when you do, what almost always happens on that very first trade? Yeah, I hate to say it like that, but it's, I don't know, when you get to that point when you're watching something, and I'm sure you guys have done this before. I know I've done it many, many times. you'll watch some, it doesn't matter what it is on your chart. You could be watching a moving average. You could be watching your Bollinger Bands. You could be watching Fibonacci's. You could be watching a channel line or like a trend line. And man, you're sitting here going, man, every time it sees this, it bounces right off of it. Okay, I've seen it do it like 20 times. Oh crap, I didn't trade. There's 30 times. Okay, I'm going to do it this time. And almost inevitably, that first time you get the confidence to trade it, it fails. A lot of people at that point do or have the exact opposite reaction of what they should. A lot of people at that point then say, you know what? I'm never trading that stock again, or I'm not entering the next trade. Now, I'm sure you, like me and many other people, have had experiences where a trade is made, using a specific system, and, it might even be explained. You might understand everything that's going on with it. You lose on the trade. And the next trade is maybe put out somewhere where following that same system, and you say, I lost on that last one. I'm not going to make this next one. And what happens when that's the case? Typically, you watch somebody else profiting on a trade, right? Yeah, and that's usually the one where it's like, whoa, that's way more than we ever expected. The point I'm making with it, before we even talk about a trading system in general, is that before you trade any trading system, spend a little time studying it. And once you've studied that system and begin to trust that system, trade it every time. There's nothing wrong with you setting aside money in your portfolio. I know a lot of people think that, the market opens at 9:30 a.m. Eastern time, and by 10:30 a.m., they need to have every penny they got put into something. But there's nothing wrong with leaving portions of your portfolio available for systematic trades, which does mean at times that there's going to be some money that's not always actively being used, right? For instance, let's just look at this weekly chart, okay? And we'll take it back. Can't really go back a full 5 years on Facebook. But when we talk about swing points, we're talking about high and low closes. Oops, I got to select the right line here, don't I? There we go. We'll just use a price level, a horizontal line. Now, one of the more difficult things people can do, I call it playing the red candle, green candle game, is they can get too focused on these little shark's teeth. These times where it goes down a candle, up a candle, back down a candle, and creates these more rapid moves. What you want to focus on is visible up and down moves, okay? So starting at the point that I'm here doing these horizontal lines, do you guys see where and why I marked these 2 points as what we would refer to as a swing high and a swing low? Does everybody see or have any questions about why I would mark those 2 points as such? Well, remember, it's high and low close of a visible up or down move. Through this time, basically from this top down to this bottom I marked, you made lower lows, right? Lower lows, lower highs, that's all one move. Up through and to this point here, I was making higher highs, higher lows. which again is one visible up move. Now, again, I would have a swing point here, and I would have one here. I'd put one here, and I'd put one here. I'd have one here, and I'd have one here. I'd have one here, and I'd have one here. Now, my next question is, why won't I put one up here? Why am I not saying, hey, let's put one up here right now? You guys are right. I don't know if the up move's over, basically. To confirm where the up move's over, I gotta be looking up at it from below it, right? It would have to come down for me to mark the swing high. Now, for me personally, one thing I like to do on my charts that I use swing points for, because as time progresses, you might have valid points on your chart that you can no longer see where they started from. You ever have that problem before? You put a line on a chart and then it takes you forever to figure out where it started from. So I like to color code mine. For swing low points, I use a red line. For swing high points, I use a green line. So I'm going to take just a second and color code my lines here. Oops, meant to color that one red. Now, one thing important, if you're keeping notes, you might want to look at this. One thing that you'll find very, very accurate, and again, nothing's 100% accurate in the trading world, but to a high percentage of accuracy, is what constitutes support and resistance using a swing point trading system. On the way down, it's actually prior swing highs that will serve as support. So what I mean is if our first support was going to hold here on Facebook, it would actually be this green line that we would look as a support point. And prior swing lows serve as resistance on the way up. So if this stock was trending downwards and we were looking at an up move, if we were trading with a swing point trading system, we would be looking at those red lines to serve as resistance. And if we're long in something, meaning traded for the up direction, what would we look to do with a long if it hit one of the red lines on the way up? What would we do with a long if it hit one of the red lines on the way up? We would take some sort of action to sell, whether that just be sell at resistance or sell via like a trailing stop. it would be an action we'd need to take, because two assumptions that, I tell people to make for their trading is support will hold and resistance won't be broken. The reason I ask people to make those assumptions is because most people prefer momentum trading. They might not say it like that. They might say other words that basically, if you were to sit and play a million questions with them, you would find out they're looking for momentum trades. Why? Because they're quick, and you basically sell a momentum trade. Once the direction and volume start dying off, they're fairly easy to make. But the biggest thing, they're quick trades, right? If you make the assumption that support will hold and resistance won't be broken, it'll actually be the time that your assumptions fail that trades are created. Most traders actually start their trading by making assumptions that force them to make trades. And most traders fail. If you make assumptions that have you wait for trades and make your trades when what you're assuming fails, you'll find that the trades that you are actually making are momentum trades, breakout trades. Higher volume, and usually higher profits. And always faster, okay? Momentum trades are going to make the move, however big the move might be, faster. And that's an important thing to a lot of people. So I want to make a quick observation on this chart with the lines that I now have drawn on it. Is there any quick observation that people can make just looking at this chart with only the lines I have on it? Any observation that you could make looking here that might not happen all the time, but has happened most of the time? Swing highs don't typically act as resistance on the way up. It's prior swing lows. And, just a couple basic trading principles. Anytime you have a higher low, you're actually expecting what? A higher high, because that would kind of be in that identification of a trend. So you wouldn't be looking at your prior swing highs necessarily as a resistance point, but I think you're on the right track, Dan, looking at the swing highs. What do you see since Facebook had its IPO debacle, fell, and in the summer of, what was it, 2013, had that earnings that really skyrocketed? What can you see about the swing highs since that time? What action could I have taken every time it broke a swing high and still made money almost every time, if not every time? There you go, Ryan. I could have simply entered a long trade. When it broke the swing high here, long trade entry. When it broke the swing high here, long trade entry. When it broke the swing high here, long trade entry. Now here, if I'd have taken a long trade entry, this was the only time it dipped back below the swing high. So what would that tell you about this as a swing high? No longer valid, right? Which would mean our swing high would move to here. And then again, when it broke the swing high, a long position would have made money. And again here, a long position on a break of the swing high, could have made money. Is there another observation that you're able to make in relation to those swing highs being broken? What are these little dots and numbers here towards the bottom of my chart? There's one that when I put my mouse over it says earnings on 11/4/15 after market. And then when I come over here, you actually see when I line my crosshair up to where the vertical line is straight through it, there's something very, very ironic about what you see when you run that vertical line straight up through it. And it's something that could actually be helpful to you for your trading. And here's what I want to point out about it. Now, we don't know the result of tomorrow's earnings. We can guess, we could speculate, we could spend all night fighting about it. But back here on this week when it had earnings, do you notice where the high was made? Yeah, just prior to it, right? Now let's go back here. Well, this is a weekly chart, so it would have been like a week before. Now let's go back here. Do you notice where the high was made? Before the earnings, right? Now let's go back here. Do you notice where the high was made? It's once again before the earnings, right? And over here, where was the high made? Before the earnings. If we go back over here, you could actually make a good fight that this was one time that it broke the swing high on the earnings. But if you're trading options, did you have to take that risky trade for the earnings, or could you trade it breaking the swing high after the earnings? Again here, where was the high made? Before the earnings. Here, it had earnings and then went higher. We'll give it that. And here again, the high was made just before the earnings. Now that's 2 years of earnings, and there's 2 times that the high wasn't made just prior to the earnings. But how could you calculate that into just this observation and how we could maybe use this to really tailor in a trade plan for Facebook using the swing points? How could we use that observation of not just every time it broke the swing high, if I go long, I'd make money, but then everybody, there's 2 questions people always have. When do I buy, and what's the other question? The first question is, when do I buy? What's the other question? When do I sell? Now you could say, well, what about those 2 times where it made highs after the earnings? And, I'd have to be one that say, well, would you be willing to lose on the other 6 to make money on those 2? Or would you have rather sold before the earnings on all 8, in which case all 8 of those situations would have made you money? And what do you think the more healthy answer would be for your own particular trading account? The one that happened twice, or the one that happened 6 times? Now, personally, I am one that's also big. I know a lot of people have a bunch of crazy stuff on their chart, and they'll have Bollinger Bands, moving averages, bunch of Fibonacci things. They'll have horizontal lines. They'll have vertical lines. They basically just look like a kindergartner got a hold of their chart and had a box of crayons. Personally, I wouldn't want to put something on my chart that's not directly related to how I'll trade it. And a lot of times when you simplify things, you're able to identify very easily something that has a probability that you might not have noticed. Maybe you trade Facebook a lot and you just never noticed that. Has anybody ever noticed that simple observation on Facebook about, if I just waited for it to break the weekly swing high, I pretty much have a winner that I would look at no matter what date it is it breaks it. I want to sell it when. There we go, before the earnings. Now, if you're waiting for it to break a swing high, what does that mean about your ability to, or your probability of calling the low? Are you going to be very accurately calling the low of a stock if you're waiting for it to break a swing high? I don't think so, because that means you're waiting for it to go up first, right? A lot of people put a lot of focus on thinking trading's about trying to call the absolute low and the absolute high. And they typically find either they're super disciplined and never make a trade, or they're not very disciplined and every attempt at calling the low completely wipes out any benefit they gained from the 1 or so percent of times that they were right. So let's also kind of look at this really quick, because I do think it's a pretty good observation to be making, especially with Facebook's earnings tomorrow. If we were to focus on a trade plan on Facebook's weekly chart using options trades and the swing points, first and foremost, what would we want to wait on to happen before entering a long? True, we'd want to move down, but I was looking more for breaking a prior swing high, right? And no matter what day it broke that swing high, what would we want to look at for the expiration of the long trade we'd be making? Well, what I would say with that is you would actually have a couple choices with it. You could actually look for one that expired like the week before earnings, in which case you run a little more risk, because if it makes that high the week before earnings, you've got to be dead nuts and pretty well in the money on your strike to actually profit from it, right? But if you go for an expiration after the earnings, what is likely that you'll be seeing for the price of those options? Inflated premium. But if your goal was to sell before the earnings, would you be losing any of that inflated premium? Or would that earnings inflation still be in place when you sold? And sometimes you'll actually find out that the inflation will actually increase as it gets closer to earnings, huh? Didn't we see that on First Solar the other day? So sometimes there could be a possibility, and I won't just say a possibility, I'll say that you could actually see it often, that even in the situation where you might not get a lot of movement, as earnings gets closer and closer, you'll see the value of those options increase. Now, excuse me, I had to cough. Anyway, when looking at this type of thing, it almost looks easy, doesn't it? It almost looks easy to say, wow, all of these times on Facebook, if I just wait, it's got to pull back first. And if I wait patiently for it to break the prior swing high and I go long with the intent of selling right before earnings, it just looks like it's easy. What makes it hard for somebody? I mean, we look back at all this, and a lot of us have traded Facebook during this time. So what makes it hard to make that trade? Staring at it can make it hard. Yeah, that's one reason I do not like looking at my swing trades during the day. But what can make it hard is when you switch your view of the chart to this. The lines are in the same place, but the chart now looks a lot different, doesn't it? The chart now can be quite a bit confusing when it comes to times that might look like this right here, and get you to make the wrong decision. So one thing I would also encourage you to do, if it's easier for you to look at that on the area chart, where it'll be the close of the weekly candles that really governs your trade, then don't allow yourself to constantly be switching back and forth and back and forth and back and forth. And also don't, like Leonard said, you can't stick to the plan. Don't allow yourself to break your plan. What I mean by that is if and honestly, I think you should, if I write down a plan for the trades I want to make, for instance, wow, I was just studying Facebook. I pulled up the weekly chart and what I found was with swing points on it, every time it's broken the swing high, I can make money on a long trade, but I need to sell it before the earnings. What does that really mean? Does that mean I buy it here and then going back over to this other chart and maybe even now looking at it on a daily chart? Does that mean I buy it here because it broke? Well, now I get a red candle. I need to hurry up and sell that because I'm freaking out. Or, oh, it gapped up here. I got to sell that. Or does it simply mean that I need to stay patient and focused, know when that earnings is, and do exactly what my trade plan says in the sense of buy it on the break and sell it before the earnings? And in that case, when would you look to sell that long if you would have made that long right here, which would have just been a couple weeks back? If you would have made that long entry, when would you be selling Facebook calls or even commons if you chose to do it by commons following that same thing? Well, because their earnings is tomorrow after hours, you could even get away with selling it tomorrow. The point is just to not be holding them when the stock does what? Has its earnings. Now, there is some exception to that for the people that have those what if questions. Let's say on, a bigger move, like if you're in it for one of these or one of these, that your profit is, well, to say the least, exceptional, to where you could still have more than you started with and maybe even keep some of the position. Would that be a time where you could play the what if game and maybe hold into the earnings? And people say that, but actually back here, I was a moderator at another chat service, and I had actually made an alert, not because of swing points, but for something else. It was for a swing on something I found that didn't have any premium inflation. It was Facebook $25 calls with the October monthly expiration in 2012 or 2013, sorry. And then it had earnings. Well, they were pretty much already in the money before the earnings. And it got clear up into here, getting ready to have earnings. And actually, I think it was over here. And I sold like all but one or two contracts. I paid $1.10 for the contracts. And when this thing's at 51 bucks, what would $25 calls be worth just in intrinsic value? There we go. So when you take that on a percentage of things and you had 20, 30 contracts, Was it a bad idea to keep 5 or 6 of them just to see? I can tell you by the time I did sell them, they were less than where I could have sold them all over in here. The point I'm making is, was it worth the chance in that case? I think it was, because it was the earnings in general that made it do that. Now, some people look at stuff on like swing points and they'll say, well, you know, that's all well and good. You're looking at a weekly chart, but how can that apply to short-term trading? Can anybody think of a ticker that I talk about swing points all the time as it pertains to whether or not it's even going to be a good day-to-day trade? And it's on a 15-minute chart that I talk about it. The SPY, there we go. It's my indicator chart. And what I use is swing points. It's really simple to me. What I'm looking at with swing points is on the SPY's 15-minute chart, if it obeys the rules of swing point trading, meaning on the way down, a prior swing high will serve as support, or on the way up, a prior swing low will serve as resistance. If it's obeying those rules, then it's generally a good day-to-day trade. Does that always mean it's a good day-to-day trade, the SPY? Or do I use that to decide if it's a good day to trade other stocks that move with the SPY, positive beta stocks or even negative beta stocks, but in general, stocks that could give me some consistency? And the answer is I like to use that on the other stocks. What that also does is you'll actually find a lot of times where other stocks, they're going sideways or they're being goofy, but at a time where you see a break of a swing point on the SPY, you generally see those other stocks do something as well. Now, I'm just going to assume that maybe at least one of you guys has your broker platform up and can look at something, but I'm just going to put a horizontal line on my chart right here. Now, can anybody who might have a chart up tell me what stocks like Apple started doing between 12:15 and 12:45 on Monday of this week, so yesterday? What did you start to see on stocks like an Apple, maybe on a Chevron, possibly on a Facebook? Maybe we even saw it on some stocks that really aren't US index based, like a Baidu that we watch all the time. What did you see basically from, actually it would have been about noon to 1? Anytime during that time up till about 1 o'clock. Is that the time where those stocks began their moves by chance? Let's go over and look at it real quick. Let's look at a stock like Apple. Let me delete some old lines off of it. And let's look at yesterday. Now, Apple, hey, it was flat through that time. But did it follow the direction of the SPY's move? Facebook, if we go back to yesterday during this time, did it follow the direction of the SPY's move? Netflix yesterday during that time? Did it follow that direction of the SPY's move? Again, the answer is yes. And let's go over and look again with the S&P in general and how I use the swing points on it to indicate, whether I even want to look at trades. Now, again, I'm not one that cares much if I call the exact low or exact high of something. I care more so if I can consistently find opportunities of higher probability. But let's look at swing points in general, and we'll just mark out, I've got a 15-minute 5-day. And to save time, I'm just going to mark the high and low, swing highs and lows as blue lines. And I want to stop kind of at this point here. And mark in right there as well. But during a time where we were failing to fall below swing lows, do you see where even for a scalp, short trades, we fail to swing low, and then look at the subsequent candles. What did they fail to do? What did they fail to do in relation to, let me make this one a little bit bigger, to just the prior swing low? I'll make it just a little bigger than that. That's a little hard to see a difference in. We'll go to that. What did the candles fail to do here? They failed to close back above it. Now, because this is a 15-minute chart, are you going to be using this to dictate all your swing trading plans? Or is it strictly for your depiction of what's happening right then? Okay, so there we go. So as we were to look at this, and if I zoom into it and see if it'll let me go back far enough. If we were to go through this, and now granted, maybe you didn't catch any of this slide off Friday, but then it does this right here. Now this is what, this candle closed at 3 o'clock in the afternoon. What can we say about some options that expire that day, because that's a Friday, at 3 o'clock in the afternoon? What are some things we can say about that? They're cheap. And not just are they cheap, but what can we say about the volatility? What could you say about the volatility of those options? Let's put it this way. At 3 o'clock on the SPY, as you failed 208.52, it would have been, 208.52. I'm pretty sure even the 208.50 puts would have been pretty cheap. Don't you think? Don't you think those probably would have been less than 15, 20 cents? And the answer is actually, yeah, they spiked up about 15 minutes after this to 30 cents. But right in here, they were about 15 cents. Because the volatility's so high, on Fridays when I am doing day trading and whatnot, what do I typically use as a rule for my sells on day trades that I put it in as soon as I buy them. And I talk about it every time I discuss making a buy on a Friday. What do we do with half of those contracts that we bought? Sell at 100%. So, if you were paying attention last Friday when this happened, on this break, you could have been buying these at 15 to 18 cents. They got up to 39 cents just in the next candle. which means what in regards to how much money you would have had in the position? Would it have been a free position after that? I mean, quite literally, you buy here and within 15 minutes, you sold half at 100%. If you sold half at 100%, that means you got your money back, right? So then, after that, anything you sell, what you have remaining is profit. So whether you said, oh, starting to go up, I'm done with it. I'm guilty of that, right? Isn't that what I did? This candle started to go up and I said, okay, guys, I'm done with it. I'm selling what I got and gonna call it a weekend. And then that happened on the last candle. Now that one's a little bit crazier in the sense, but what I'm trying to point out with it is that was quite a bit of a head fake in relation to what happened come Monday, right? Wow, we just failed this support. It's been consolidating. It fails it. But if you got to understand, if you're using the short-term chart, an intraday chart, then essentially every day is a new day, right? And what you need to really see as that day starts out, and what I like about the SPY and the consistency it has is, sometimes you've got quite a bit of space between your lines, but many times what you find is that if you simply wait for the breakout plays, and as that resistance is broken, we saw that like on Apple and Facebook, it wasn't right the very second it happened, but it followed the move, right? In relation to today, when today opened, let me zoom just a bit and we'll go through and kind of talk about it. When today opened up, we had a bit of a gap down. But had we failed a support, or was the support down here? The support was right here, wasn't it? Okay, so we haven't failed support. Assume support will hold, assume resistance won't be broken, and then, okay, if you took a little trade in, the gap felt good, but if you're talking about consistency, one thing you can do now is say, well, that's a new swing low. And over time here, what would you have indicating to you? When you see this, you could also be looking at what? And I'm referencing if you use this chart as an indicator like I do. You could just trade it straight up on the SPY. I've always found that no matter how disciplined you try to be, once you enter a trade in something, you start to think only in regards to how it could affect your trade. Meaning, like if I buy calls, I've got to find ways to justify, oh, well, I see it shouldn't go down below this line, but once it does, I'm like, well, let me put a line here and let me put a line here, and I let it fail all these lines, and I got this line. I'm like, well, let me see if it fails this line. And then when it fails that line, I just go, oh, shoot. And that's not what you really want to do. You don't want to talk yourself into reasons your position might end up working out. You want to have some basis of an indicator. Now, you might look at other stocks like Apple. You might look at CVX. You might look at even like Facebook or Netflix during this exact same time when this candle happened. And what you might find is they had already made some considerable up moves. But what did they do again at the time where the resistance was broken? What did they do at that time? they moved up more, right? Regardless of how they looked prior to that, the SPY broke that resistance point and they ran. Now at this point right here, what would we be looking for the SPY to do to remain trading nice according to those swing point rules, and telling us if from that point forward we would be seeing good day trading opportunities? What would it have needed to do? It needs to hold this line right here. So I'll make it thicker. And as time goes by, you know, you got a move that maybe it didn't last very long. But what came and happened right here? Was this bearish because it made a red candle? Or was this still all bullish? So by bounced off support, Leonard, you're saying this is all still part of a bullish move, right? So even if you bought some calls here, you didn't necessarily need to sell just because you had a red candle. You would have had to sell if you failed support, though. But at this point, let's say you missed this first one and you see this happen. What is this an indication for right away? There you go. If it also would not be a stop out long, it would also be a buying opportunity for that long. And as it held support, wouldn't you have had to say, well, you know what, that kind of created a new swing high here. So I have to see if it breaks that, which it did, and what then becomes support. This top line, right? Now, as time continues on, is this move bearish? Or are we still following the swing point rules? So still bullish and still following the swing point rules. And do you remember what I was talking about using the swing point rules on the SPY 15-minute chart to determine? What was I even using it to determine? It wasn't necessarily a trade on the SPY, wasn't even necessarily a trade on another stock. It was if it traded nice by the swing point rules, I would look for day trades. So at any point that it stops trading nice by those swing point rules, meaning a pullback that does not hold a swing high support, what do I kind of need to do here? What would I need to do on a pullback that didn't hold a swing high support? Well, I'm kind of referencing as if I wasn't even in a trade and I saw the SPY not trading nice with these swing points. What do you generally see when you have a day where the SPY breaks the swing high but then immediately fails back below it and then fails the swing low but immediately goes back up above it? Those are pretty much the worst days to trade, aren't they? There's pretty much no worse situation for trading than that one. So using the SPY simply as an indicator to say, is it following my swing point rules, what I can find is that all throughout today, there were many stocks that gave good day trading opportunities. Would you agree? You might not have caught them all. I might not have caught them all. But you could look back now and say, man, there's a lot of stocks that I could have day traded today. And I could have day traded them simply based on how well this does here in conjunction with the swing point rules. And what are those swing point rules again? What are those two swing point rules? Swing highs will serve as what on the way down? Support. And swing lows will serve as what on the way up? Resistance. So before you get all kooky and crazy about entering a trade because you see a red or green candle for a day trade, pull up your SPY chart. If the SPY moves up tomorrow off of this swing high, take the opportunity to day trade calls with your stop obviously being here. But if it fails that swing high, wait long enough to let it fail a swing low, which would actually be right off of this candle. I know they're kind of close together and I didn't change the color of them. And use that line as your resistance or stop on a short trade. And what you'll find is even though up moves can have red candles in them and down moves can have green candles in them, what you'll find is on the days where it obeys the rules of that swing point trading system, you're going to have a whole lot of trading opportunities, not just on the SPY, but on pretty much any stock you could want to watch.